Good afternoon, Mr. Chairman. My name is Phil DePaul. I teach English at St. Joseph's High School in South Bend, Indiana. I'd like to personally thank you for your continued diligence and perspicacity during these tough economic times. My question, can you discuss what you see going forward as the strengths and potential shortcomings of the Dodd-Frank legislation, and what types of safeguards have been put in place to prevent a future credit crisis? Thank you.
Thank you. That's a very good question. So the Dodd-Frank legislation, I just spent the morning actually in testimony at the Senate Banking Committee talking about implementation of the Dodd-Frank Act. This was the omnibus financial reform that was passed again in July of this year, and it's very, very comprehensive. It is certainly by far the most comprehensive financial regulatory reform since the 1930s. And it makes a lot of fundamental changes in our financial system. To name just a few of them, it creates a Financial Stability Oversight Council, which the first meeting is tomorrow, by the way, which brings together the heads of all the regulatory agencies and says, let's all work together to see if we can identify any risks that might be arising in our financial system. So one of the problems that happened before the recent crisis was that everybody had their own little responsibilities, but there wasn't really anybody in charge of looking at the system as a whole. And what this legislation does is greatly strengthen the provisions to require regulators not just to look at their individual fiefdom, but to look at the whole financial system and try to identify risks that might be arising as the economy changes and the financial system changes. So that by itself is a major change. In addition, the Dodd-Frank Act closes a lot of gaps that existed. We were just talking about bailouts. AIG, which took important steps today to begin to pay back the government, was essentially not regulated by anybody. Nobody really was paying attention to what was going on there. The investment banks, like Lehman Brothers, had very limited regulation. Their only regulatory scheme was a voluntary scheme. There was not any legal requirement for them to be regulated. There were many gaps in the regulation of exotic financial instruments like derivatives. So there were many gaps, and many of those gaps came back and were very serious contributions to the crisis. And so the Dodd-Frank Act closes a lot of those gaps and creates new oversight responsibilities for the Fed and for the other agencies. Let me mention two other things it does. One is it's going to create a consumer protection agency, and we've been talking today a lot about financial literacy, about people who got into trouble on their mortgages or their credit cards. Some of that is the fault of the borrower, but some of it, of course, is bad disclosures or bad practices on the parts of the financial institutions. The Federal Reserve has been working hard on consumer protection under my chairmanship, and this new bureau, which will be within the Fed but independent, will also be responsible for trying to provide those protections. The last element I wanted to mention, which is new and important, is that there are provisions now in the law that will make bailouts both unnecessary and illegal. That is, should we ever come to a situation where a big financial firm is about to collapse and that its collapse poses dangers to the U.S. economy, we now have a set of rules that would allow the Federal Deposit Insurance Corporation to come in and seize that institution and wind it down in a safe way that will not cost the taxpayers any money and that will not, at the same time, will not create chaos in the financial system. And if we had had that 3 years ago or 2 years ago, we could have avoided a lot of what happened. And so all those things are very important contributions and will help address financial risk, financial crises going forward. Now, this is not a panacea. It's not complete. There's a lot to be done. As our hearing talked about this morning, passing the law is only the first step. The regulators have to implement these laws, which means we have to devise a whole set of rules and regulations that will make specific and concrete for the financial firms and other regulated entities what those laws mean specifically. We have to enforce those laws. That means we have to strengthen our supervisory arm and make sure we have all the resources and talents we need to enforce those rules. So that's a lot to be done. And there's still things that even Congress has to address. For example, one of the major problems that arose was the collapse of Fannie and Freddie, which were the two large housing agencies which had implicit government guarantees, but turned out to be had to be taken over by the government because of their losses in subprime and mortgages and other lending. So that the Fannie and Freddie reform is something that it needs to be done. It's not part of the bill that was passed in July. So that's an example of something that needs to be done going forward. I guess one last thing. One of the things that made this crisis so difficult is that it was absolutely a global crisis. It was all over the world, particularly in other industrial countries in Europe, and that required a great deal of coordination. And speaking for myself, I worked very closely with central bank governors around the world. We coordinated on lots of different measures that we took. And that's going to be necessary also as we all go ahead and impose new rules in the financial marketplace. We don't want to have one set of rules in the US and another set of rules in France and a third set of rules in Japan, because financial companies will just take advantage of whichever rules are the weakest. So what we need to do is make sure that we're as coordinated as possible. And in fact, we are very much involved in international meetings. I just came back a few weeks ago from Basel, Switzerland, which is where many of the largest countries of the world get together and talk about coordinating and making consistent our bank regulatory standards. So the international part of this is very, very big. It's going to take a while for us to not only get a good system in the US, but to make sure that it is consistent and coherent with the financial regulatory systems of other countries. So there are a lot of challenges ahead. We're not home free by any means, but I do think that this legislation, which, as I said, is by far the most sweeping since the 1930s, will give us a fighting chance to set up a system that will prevent what happened in 2008 and 2009 from happening again.